Okay, we are recording Personal Finance, Chapter 12's life insurance chapter for the static problems to do with this video. And we are in the midst of me going to get my spreadsheet. So hang on just a minute and I'll go get it. So Chapter 12 is the last chapter about insurance. And we were just discussing the fact that insurance pretty much all boils down to risk. If there's more of a risk that you're going to need that insurance, it's harder to get. Okay, it's harder to get. So basically, the insurance company is kind of betting on you that you will live longer than the insurance. So some insurances only last a certain time. That's called a term in a policy. It only lasts 10 years or 20 years or whatever the policy says. So they're betting that you will outlast it. Okay, so let's go ahead and look at a table that tells us what the life expectancy is of a 40-year-old male. Now, I don't know how old this table is, because we've been looking at it for, 2021. All right, a little old. So here's what you're reading, okay? Here's what you're reading. Notice what seems to be the case. If you look at a newborn baby, for whatever reasons, statistics, Shelley and her statistics class, and people that are known as actuaries, put together all these numbers and statistics and tell us that an average newborn child, I don't know, doesn't matter where they live, apparently, a male will last 73.5 years on average, a female 79.3. Okay, you say, why is the difference? I can't answer that. Just the statistics, I would say probably because of maybe a little bit more risky behavior. Does the same thing for car insurance rates. A lot of times it matters what gender you are, how old you are, things like that. So life insurance goes along with that too. All right. So we have a 25-year-old male. Wait. Hold on. Let me go back where I was. 40-year-old male, right? I have that in my paper here. 40-year-old male, use the table. So you start with 40 years and then you go find that age in the gender, and then you add the amount that's beside it. So let me see. It's gone down since the last time this table was together. Oh, wow. Okay. So 40 is actually 36.6. So I have to change my formula here. What does that mean? Does anybody know what that means? You say, no, I don't. Tell me what that means. What that means is we are actually living shorter than the last time I did this. The last time I did this was a different table, right? So it was probably older than 2021. And for whatever reasons, now this new table's on there, and they're saying that a 40-year-old male average expectation of life is another 36.6 years. And I had 38 point something up there before. So like I said, what this is saying is we're not doing better by trying to, I mean, I think we've done this. I think we've made it over the longest amount of time to live. And I don't think we're taking as good a care of ourselves and things. I don't know. That's just what or maybe it's the fact that there's just more people in the world. I don't know. That could change it too. So anyway, let's try 76.6 years. So whatever age the person is, then you just simply add the amount that's in the column, right? So I'm 57, just turned 57 in September. So I'm somewhere in between 55 and 60. So I would add somewhere between 27.8 years and 23.7 years to my age, as far as how long I might live, right? I can live longer. I could not live as long. It's just these actuary tables tell you information based on statistics, right? And what does it say? All races, right? So there's no difference between a race, and I don't think it matters where you live or any of that stuff. And by the way, here's the source: National Vital Statistics Report. Okay. It was 2021, but it looks like it was updated in 2023 based on what I'm reading here. So it also has a mention that it was accessed February 17th of 2024. So, that's interesting. I don't know. All right, so let's put that answer in. I'll try not to dawdle so much here. All right, so the answer should be life expectancy 76.6 years if my calculations are correct. And it looks like it's okay. All right, so I am going to refresh this and see if I can get it to adjust. There it is. Okay, we're going to do the same thing for the next one. So once again, the first one is 76.6. When you add the amount for a male, that's 40. Okay, now let's go to the next one. Okay, the next one is determine the average number of years, additional years. So they want to know the additional years of someone who's 35 and that is a male. All right, so back to the table. Okay, back to the table. So this one is 35. So it looks like additional years are 41. See, that's lower than the last time I did this. So we're not making improvements on living longer. We're actually going the other direction. All right, so 41 years, they said additional years, not the expected age, okay? Additional years. So those are going to take a little more careful reading when you look at it, okay? Number 3, how about, I think a female here, if they follow suit. Yep, determine the life expectancy of a 60-year-old female using that same table. So now we'll go to the female column and look at 60. So another 23.7. Okay, so I got to take 23.7 and add it to 60. And then they want to know the life expectancy. So this isn't the additional years. So it looks like she's expected to live, if everything stays the same, 83.7 years. Okay. Say, why do you want to know this? Well, if you're going to buy life insurance and you want your life to be insured till you die or not, you need to kind of get an idea of how long you're expected to live. Okay, everybody okay with that? And like I said, it's an actuary. That's a career that you can get into if you're good at math and you like to do that kind of stuff. It's kind of research, but they did. What? Go ahead.
I'm actually considering going into actuarial science.
You are?
Yeah, Washburn.
Really? I didn't know Washburn had one. So I hadn't researched that before. Very interesting.
Only from Kansas.
Really? Well, no wonder I haven't. But thank you for telling us that. I didn't know that. Yeah, so I think if you can get through it, I think it's a pretty lucrative profession.
It's on average they make more than a CPU.
Yep, I believe that. I believe that. Well, that's good to know. All right, I'm glad a lot of crunching numbers, crunching and using formulas, and I wouldn't even begin to know what all is involved with that, but that's good that you know that, and I'm glad to hear you're interested. So, all right. Now, here's the next step we're going to learn. When you first start thinking about life insurance, you pretty much need to come up with, well, how much life insurance do I need? You don't want to pay for more life insurance than you need. So there's different ways of determining how much you need. The first one is called the multiple of income method, all right? Multiple of income method. So if you come across this one, you want to take your income, okay? Okay, and it says, use the multiple of income method to determine the minimum amount of life insurance. The minimum is 5 years. 5 years worth of your gross annual income. Gross means nothing's been taken out of it yet. I don't really like using gross income because you can't spend it. I'd rather use net income, but whatever. All right. So how are we going to do this, right? So if you have $62,000 worth of annual income, so they're still using the same one they used last time, we're going to take that times 5, and that gets you about $310,000. And so you might look for a policy that pays that or a little more, just to kind of be in the minimum. Once again, life insurance determination depends on who is dependent on you to live. If you have kids, if you have a spouse that is dependent on your income, if you have a mom that lives with you who's dependent on your income, it all depends on your situation, whether you want life insurance and how much. All right. So the minimum with this kind of gross annual income is that number times 5. So I think we're looking at 310,000. And just for kicks, I'm going to make sure that my formula is correct before I enter it in. So I think that's right. So you would want a minimum policy of that much, right? If you're going to follow what's called the multiple of income method. So this is a method to determine how much life insurance to apply for. All right, let's do it again in number 5. Okay, so if you have a gross annual income of 65,000, use the multiple of income method to determine the maximum. Okay, so based on this method, they say the maximum you need is 10 years. Now, I don't know if that's true. I don't know. If you've got a newborn child and you want to insure your life, it's going to be a while before that child is able to support themselves, definitely more than 10 years. So anyway, but if you're using this multiple of income method, the minimum is 5, the maximum is 10. Okay, so if you want to write that down somewhere, that is what this method works with. So if you have 65,000 as your annual gross income times 10 would be insurance of 650,000. Okay, there's different ways to shop for different policies. I think you see commercials on TV quite a bit. You can go get on certain websites that can compare different policies and things like that. So the world of life insurance can be rather complicated, right? And you do want to understand what you're paying for, because if someone actually needs it, then you want to make sure that it does what you expect it does for that beneficiary. So if you are a life insurance holder, like I have some life insurance on me. Okay, so if something happens to me, my beneficiary is my husband, right? So the beneficiary is the person that receives the proceeds from life insurance. Want to hear something cool about life insurance? The proceeds, the money that's collected from a policy, you get to have that or keep it and not pay federal income tax on it. Yeah, so it's one of the very few flows of, it's really not income, it's a proceeds from a policy. But until the tax law says, okay, we're going to include insurance proceeds now, which I wouldn't be surprised if they do sometime, this is money to you that's basically federal income tax free. All right, now we're going to use something called the easy method. So once again, these two were the multiple of income method. So I'm going to highlight the name of the method, okay, because That's the key to knowing how to calculate it, okay? Now we're going to do the easy method. The easy method. All right, so the easy method says that if you are the wage earner in a typical family with a $70,000 gross annual income, use the easy method to determine how much life insurance you should carry. Here is the formula. You ready? Here's the formula right here. You take your annual income times 7. So that'd be 7 years worth of income. Then you take that number times 70%. You say, why? I don't really know why they chose 70%, but that's just the way this easy method works. Okay, I'm sure there are some statistics behind it to lead the way, right? So I put the 70,000 in where it says annual income. I take it times 7, and then I take this number times 70%. And unless they've changed it in the book since I've seen it last, I think this should work. Okay, so this one has its own formula. Okay, and we'll see a couple of others that have their own formula too. So I'm going to put 343,000 without looking to see if that is still what the formula is, but I'm going to imagine that it is. Okay, so once again, this is just called the easy method. And there's that easy method formula. So I'm actually going to put that here. This is the easy method formula. I used to have my life insurance license. There was a time that I was considering going into the financial advising world. And unfortunately, that world is kind of hard to deal with at first because you don't make a lot of money. And when I started doing it, I was older. And my husband came down with cancer and I couldn't continue. So I had to go get a job in the accounting field where I could make a little more money. So things happen, but yeah, that training that I got helped me a lot with this class. So, all right, let's do the easy method again, right? The easy method again. Okay, so one more time, the annual method now, or the annual income now changes to 65,000. Okay, and we're going to use that easy method again. When you put 65,000 in there times 7, and then times 70%, you get 318,500. Now, I doubt you'll find a policy that pays exactly that. Most policies round up to a pretty, like 125,000 or 350,000. Or something like that. I haven't really ever seen a policy that pays down to that specific of a dollar value, is what I'm trying to get at. But anyway, that's what this method provides for this person, right? So you could use several methods and then say, well, I'm the most comfortable with this one or that one. So, and like I said, you don't really want to pay for more life insurance than you need, because that could be wasteful with your money as well, right? What happens if you live a long life and you have life insurance? Well, you paid in all that money. Now, some life insurance policies, which you're going to find out, there's term life insurance policies, they're variable life insurance policies, there's whole life insurance policies. Some cost more than others. The ones that cost more can grow in dollar value. I'm sure you've seen the commercials that say you can cash in your life insurance policy. So certain life insurance policies actually have dollar value to them. So if you decide to go with one that has that, you'll pay more, but it may well be worth it, okay? Because you might be able to accumulate a decent size amount of value in that life insurance policy, okay? Okay, number 8. Moving on. Okay, here's what's called the DINK method. DINK is an acronym. DINK stands for double income, no kids. No kids, all right? So I guess my husband and I would be considered in the DINK method if we wanted to, because we don't have any biological children. So the point of having this kind of insurance is pretty much to help the other spouse if one passes, right? So here's the formula. It is a calculation of certain amounts of money that need to be put together, right? So some of this stuff is kind of morbid to talk about. I'm sure you've never really talked about funeral expenses unless you helped, anybody help with a funeral planning before? Yeah. The funeral world is quite a racket, okay? Because we all are gonna end up at this point somewhere in our life. And I'm glad to see, I know COVID coming and going has changed some of the ways that we honor people that have passed away. We don't have to spend thousands of dollars. Some do, you know, that's their choice. But you can get, you know, funeral services or having a celebration of life. I'm going to a celebration of life Saturday up in Kansas City, right? So there's no funeral. It's just getting together and honoring the person. So anyway, they put funeral expenses in here. So they're saying that the average funeral is $5,000. Well, I disagree with that number because I've helped with several funerals over the last 12 years. And there was none that came to that small of an amount if you're working with a funeral home. So anyway, funeral expenses are $5,000. So here's how it's gonna go. We're gonna put together a calculation of costs. So we want to know about how much a funeral would cost. And then we're gonna line up certain debt. If there's a mortgage that the couple still owes on, if they have any car notes that they owe on. Notice what this says. Half of all other debt, half of it. Why? Because if one person passes, the other person's still there to possibly be able to pay for things. I guess they're also assuming that this DINK method, that each person makes about the same in income. So if you lose that income from that person, then I guess the point is you would still have the other half to work with. So anyway, they're trying to make sure that if a spouse passes, that the debt that might be owed by the couple is covered at least on the part of one person. Okay, that's kind of the idea. So we list what our debt is. So then you see, so they've got funeral expenses of $5,000. By the way, it doesn't matter how much you make annually for this DINK method. All they want to know is funeral expenses and debt. If you have no debt, then you may not want to get life insurance at all. Okay, but like I said, if you can come up with a policy that's not real expensive and keep paying it and keep it in place, you know, if something were to happen, that's some good funding that's not taxed. Okay, they got a mortgage of $100,000. They still owe $11,000 on car loans, $2,000 on personal debt, and $3,000 on credit card loans. So we add up all of these and it adds up to $116,000. We take half of it, right? And then add those funeral expenses to it. Half of all other debt plus your funeral expense. So this DINK method prescribes $63,000 as a life insurance need for, so you'd want to insure both people. And you can get a policy that does that. No, you can get a policy that'll pay off your mortgage if either spouse dies, but life insurance is one person, sorry. Life insurance is only for one person, last I knew, unless there's something new that I don't remember or something new that's come along. All right, so there's the need. If you put it into the recipe called the DINK method. Okay, let's do it again. Okay, let's do it again on number 9. Okay, number 9. So this time, DINK method, double income, no kids. This time the funeral expenses are $6,000 as an estimate. The mortgage is $190,000, $10,000 still owed on auto loans, credit card balance of $2,000. Now, here we go. Here's a little bit different than the one before. So there's the mortgage, there's the auto loans, there's the credit cards. Okay, but they say, and I don't understand it, other debt. I don't know what other debt would be. It might be a personal loan. Okay, maybe that'd be student loan. I don't know. Something different besides a mortgage, an auto loan, and a credit card balance. The personal loan was up here. It got counted. So I really don't know what all other debt would be. Okay, so, all right. So I guess it doesn't get included, I guess. Whatever the other debt is, I don't see it in my calculation. So we go with the mortgage, the automobile notes, and the credit cards, and those add up to $202,000. We take half of it. Take half of it, which is $101,000, and we add the funeral expenses. So I guess if you have other debts that you can't identify what they are, I guess it doesn't get included in here. So I guess that spouse that's still alive is on their own for that one, I guess. Sorry. I don't know. I thought debt was debt. But anyway, so half of the mortgage, the automobile loans, and the credit cards is $101,000. And when you add $6,000 to it, you have a need of $107,000 in life insurance. Using the DINK, $107,000. Okay, what did I miss? Oh, they probably fixed it. All right, that's okay. I'm willing to fix my spreadsheet. Let me put in the other debt and see if they're including it now. I can't even remember. Okay, so I'm going to put other debt here. I'm going to try it this way first. Okay, so if you add up all of that and then take half of it, it's 103,000 plus 6. So let me put 109,000, see if that's right. If that's wrong, then we'll try one more thing. 109,000. There you go. So they did. Hey, they fixed something from last year that was wrong. A miracle. All right. Nice to know. So that other debt does get included. It just gets listed as other debt. Okay, so that does get included in that half amount there. All right, moving on to 10. Now we're going to use something called the non-working spouse method. So some spouses choose to stay home and take care of kids, okay, to save money, to not have to pay for daycare, things like that, which can be very expensive, and to also make sure they're the ones raising their kids, I guess. So there you have it. So here's how it works. Okay, it's got a formula too. Here's the formula. Okay, so let me put the formula. Let me put formula next to it. So non-working spouse formula. Spouse method formula. So what you do, I guess they believe that once a child is 18 years, well, they can go to work and fend for themselves, I guess. So 18 years goes into the formula. You subtract the youngest child's age, and then you take that number times $10,000. And this is, so Tim and Allison are married, have 2 children. Ages 4 and 6. Allison is a non-working spouse who devotes all of her time to household activities and raising her kids. Estimate how much life insurance Tim and Allison should carry to cover Allison. Okay, so I guess they would expect Allison to probably get back out into the working world after she's raised these kids. But anyway, this is how much life insurance they might look for her. All right. So you take 18 years and you subtract 4, which gives you 14. And then you take 14 times $10,000. Okay. So the insurance need for that non-working spouse should be $140,000. $140,000. Okay, so we're going to turn around and do that again. Okay, so the point is your youngest child is probably going to need taken care of. Oh, I know what it is. The youngest child is going to need daycare. If the mom happened to pass, her 2 kids that are 4 and 6 would probably have to at least go to daycare or something while the father worked. So they're insuring the mom's life in case the husband has to pay for daycare, basically, or their care. Yep, that's what's happening. Okay. So non-working spouse, 18 years minus the youngest child. So if your youngest child is 5, right? That's 18 minus 5, which gives you 13. 13 times 10,000 is $130,000. Yep. There it is. Okay. So I guess we're going to do it one more time. Wow. Okay. I forgot how many times we do this. So non-working spouse method. Plug in the youngest child's age and subtract that from 18. How about 8? Okay, so 18 minus 8 gives you 10 times 10,000. That's $100,000 worth of life insurance. Okay, $100,000 worth of life insurance. Okay, I think that's enough. Okay, now we're going to work with a little bit of time value of money. So let's go ahead and see what they're talking about. Okay. Did I skip 12? Maybe I misnumbered here. Just a minute. Let me go look. Nope, I answered it. Oh, I got 2 12s. Okay. Well, then I did misnumber that. All right, this will be 13 then. Let me go ahead and fix my numbers real quick so I don't get confused. So there should be 18 problems in this group. That might explain why I didn't get to the number 18. Yep. Okay. Back up to 13. Back up to 13. All right, so here we are. Let's figure this out. All right, it says Susan has purchased a whole life policy with a death benefit of $200,000, assuming that she dies in 10 years into the future, and the average inflation has been 2%. What is the value of the purchasing power of the proceeds? Okay, so she bought this policy, right? And it pays $200,000. If she were to die tomorrow, well, if she were to die pretty soon after getting that policy, then that would be the value of those proceeds. But apparently she's dying 10 years after paying that policy over and over, paying the premium for the policy. By the way, the premium for the policy is the price you pay to keep the policy active. Okay. And the average inflation is 2%. What's the value? So we want to know today's money. Anytime you see purchasing power, it's today's money. So we're going to look for the present value. Okay, let me plug in. So let me take this out because I don't know if it's right because I got to make sure I've got everything right. So we're looking at 10 years, 2% with a future value of $200,000. Okay. And this is going to be table C. Yeah, table C. So we're looking for the present value, which is the purchasing power. right? So if you were to get this $200,000 10 years into the future, it would be like how much, right? So that's what we're going to do. Let's go to the financial calculator. We're going to solve for the present value, put in 0 for payments, 200,000 for the future value. The rate is 2% interest. We're looking at 10 years. Okay, 10 years. The present value, all right, is $164,069.66. Yep. Okay, let's do the table. If you go to the table and look up the right one, I gotta go to my table here. I thought I had them. Okay, looks like I gotta open them again. I must have shut them. Hang on just a second. All right, here's our table. And this is present value. So it's going to be either C or D. And there's only one value. So that's going to be present value of $1. So we're looking at 2% in 10 years. We're looking at a factor of 0.820. And I've got that there. All right. So this is still good. Just wanted to check. So let me see if the one from the table is going to work. Because I've been testing the table answers, and I know you guys have probably been testing the calculator, and I appreciate you telling me when something's not working. So, yep, that one accepted that one. All right, very good. Okay, let's go to number 14. Okay, here's another one. Okay, here's another one similar to what we just did. So this is Alan. You say, what's a whole life policy? A whole life doesn't expire. As long as you're continuing to pay the premium on the policy, a whole life policy will last till you die, whether that's 98 years old or 102 or whatever, okay? The problem is that's going to cost a lot more. Whole life policies cost a lot more. Whole life policies are the ones that tend to have the dollar value later on as you're paying the policy. Sometimes they have actually a cash value you can cash it in for before you die. So, all right, this one has a death benefit. Death benefit is 150,000. Assuming that he dies 8 years from now, the average inflation is 1%. What's the purchasing power of the proceeds? So once again, the proceeds is the amount the policy is insured for. So whoever gets, okay, whoever gets this policy, right? Okay, here's what I'm gonna do. I think this one got eliminated. I don't see it. Okay, I'm gonna take this out, and that's probably why the numbering got skewed. All right, so let's try this one. Yeah. Let's try this one. We're going to try that present value again. So the payment is 0. Present value is 150,000 proceeds. We're looking at 1%, 8 years annually. I'm also going to use the table. 1% in 8 years, and you use table C. Okay, table C. So I'm going to use table C. 1% in 8 years, 0.923. There it is. So yes, the purchasing power is about 138,450, and we can confirm that with the calculator by putting in the different values, and we're down to 8 years of when he will pass. So 138,522.48, little different, but still within a pretty relevant range. Okay, so I'm going to put in from the table to see if it accepts it. Okay, so no, it didn't. So let me put in the amount from the table, from the calculator then. Okay, so 138,522.48. Okay, it didn't like this one. Okay, so I'm letting them know when not accepted. So that's, like I said, I don't think I'm gonna use the table too much more, but it really should be there because it ought to be the range, that range has been really nice because some calculators have a little more different rounding function to them, so you know,
That one has multiple answers.
do what now?
I have a different answer that I like.
Really? So you don't have 150,000, 8 years at 1%?
I have that. I'm saying like, my answer that it's saying is correct is 138,516.18.
Okay, where'd you get that number?
I was just doing it on my calculator and somehow I got that and it likes it.
Okay, let me go to this one. Okay, yeah, see what I mean? You're using whatever calculator. Okay, you can use, and Excel has time value of money formulas too. I haven't gotten into them because I don't want anybody to feel like I gotta learn Excel in here, but I may start using Excel instead of this tables. But those tables have been around for a long time. And in my opinion, the table ought to be part of the right answer because sometimes the table's all you got. And no offense, but when you're talking 138,000, right? And it's not, you know, I know it's within 18 bucks or so or whatever, 17, 18 bucks. That's not that big a deal. But even you and I using different calculator methods. So it did accept yours. You said 138,005, what?
138,516.18.
Okay, well, and if you got it to give you the green check mark or the green button, then that's fine with me. Okay, but I sure didn't get it by putting in my table answer, which is, like I said, boy, the last time I sent something, I kind of ripped them a good one. I did. I said, this is ridiculous. Don't you guys audit your solutions? You know, because obviously not. Yeah, yike. I told him, I said, you want me to do it for you every time you change versions, just let me know, because we're going through each stinking problem. And you can pay me. How about that? So anyway, nope, it don't like it. All right, but I'm glad to hear that Zach, yours took it from your calculator. Okay. Onward we go. Couple more. We'll be finished with this chapter. Okay, suppose you're 45 and have a $50,000. Where goes my 15? Boy, I think it's this one. Is this right? Yeah, cash value. Okay, hang on. All right, I've just got them mixed up. They must have changed the order or I mixed up. All right, suppose you're 45 and you have a $50,000 face amount, 15-year limited payment, participating policy. Dividends will be used up to build up the cash value of the policy. So these are all some characteristics that you can get of a life insurance policy. But we're going to compare, so your annual premium, so the amount you're paying every year to keep that policy active so that your life is insured is $1,000. The cash value of the policy is expected to be $12,000 in 15 years. Remember I said after a certain number of years, if you keep paying in that policy, right, then it becomes have a cash value to it. Now, how much have we paid in? 1,000 times 15 years. We've paid in $15,000. Do you agree with that? Okay, so 15 years later, you could cash it in and get $12,000 of your money back. Okay, so using the time value of money and assuming you could invest your money elsewhere. So instead of buying that policy, you're going to stick that annual premium in an investment account that pays 7%. What's the difference? Okay, so I'm gonna help you do this. All right, so let's get down a process here. First thing you want to know, well, what if I would have put that $1,000 into an account that pays 7% for 15 years? What would I have? And what would be the future value of an annuity of putting $1,000 a year in that investment account at 7% for 15 years? I'm going to plug this into my calculator to make sure my answer is correct. The payment or the annuity is $1,000 a year, right? We're looking at earning 7%. We're doing this 15 years in a row. So 25,129.02 is a good future value. What I did the last time. I'm still going to go do my table though. This is the future value of an annuity. So this is going to be table B. Okay, so I'm going to go give this a try. Table B, we're looking at 7%, 15 years is 25.129. Yep, that's the one I got. So then you take that times 1,000 and it's within 2 cents of what the calculator says. Now, that's not your answer. Okay, don't get carried away yet. What they're asking for is what's called the net. Remember, net means something has been subtracted. The net cost of the insurance, okay, of the insurance. So what you do is you go get the future value of if you would have invested that money in a different account instead of buying the insurance policy, then you subtract. Now, this has to be 15 years into the policy, right? So then you would subtract the cash value, okay? But once again, that cash value, let me put in parentheses, after 15 years. So you can't do this, all right? So after 15 years, make sure we know that. We're going to subtract the 12,000 cash value from the total you have in that investment account. And there's what they call the net cost of insurance. Net cost. Okay. Net means something's been subtracted. What's been subtracted is the cash value. So what they're saying is you missed out on, right? It says you missed out on basically $13,129. But the thing is, nobody has a crystal ball. Nobody knows. That is a $50,000 face, but that face is now, right? In 15 years into the future, it's not going to be worth as much, right? So the fact that basically what they're telling you is you have this policy that you pay $1,000 a year to keep. And if 15 years in, you have not passed away, if you don't want to pay for that anymore and don't need life insurance, you can then cash it in for $12,000, correct? But by the time 15 years rolls around, you would have paid in 15 times 1,000. That's not even taking into account that time value of money. So putting it in the time value of money, after 15 years, you would have accumulated about half of that face value. Does everybody see that? The face value of the policy is what? 50 grand. Right? You would have socked away the $1,000 and let it grow at 7% for 15 years instead of the policy. You would have had about half of that face value. But if you would have needed that money because you passed away somewhere along that time frame, then, you know, so it all has to do with risk. But anyway, the net cost is the difference between the total future value of those premium payments, any cash value. If there is no cash value, then the whole thing becomes the net cost of insurance. Okay, so I'm going to put $13,129. okay, that's the net cost. But if you'll find that future value of those premium payments first, and then just subtract the cash value, that is the best method for finding your answer, okay, finding your answer. All right, let's get a couple more finished up here, and then we'll call it good for 12. All right, number 16, suppose you're 30 and have here, so this is the same kind of problem. We got a face value policy of 25,000. Your annual premium is 325. The cash value after 20 years is only $3,000. So use time value of money, assuming you could invest your premium payment of $325 for 5% over those 20 years. What would be the net cost of the insurance? All right, so we got a 0. We're paying in $325. So that changes, $325. Yep. Okay, so this is going to be different. We've got a 5% rate, and we're looking at 20 years. Okay, so I've got to change this, and this is going to be the future value of an annuity. So this is going to be table C. Okay, table C. All right, let me go find a different factor, and then we can plug this in. I know if you've worked ahead, that's fine. If you could please wait. We may go ahead, I don't know, we've got about 25 minutes. We probably won't go ahead and do 13. I'll probably just go ahead and record it real quick after you guys leave. So we're looking at 20 years here, so I need a different factor. So if I go to the table, in table C, no, table B, gosh. This is the future value of that $325 every year. Okay, so future value of an annuity is what we're looking at, and we're at 5% for 20 years. So I think I'm lining up with 33.066. So looks like 10,746.45. Now let me run it through the calculator. Okay, so this premium isn't as expensive. It's because the face amount's not as big either. Okay, so 5%, and you're doing that for 20 years. All right, we're looking at 10,746.44. Off by a penny. That's not too bad. So then you take that future value and subtract the cash value. So the cash value, they said, in 20 years is only $3,000. Wow. All right. Well, it's better than nothing. So $3,000 subtracted from that future value at 5% for 15 years, which I've got to change. I want to try to make sure I'm changing all my variables to what the problem really is. There we go. We're looking at $7,746.45. Let's see if they'll accept it. Yep. Okay, they did. Very good. So this is also basically an alternative cost, right? Opportunity cost. We can either buy the premium, pay the premium for the policy with $325, or we can sock the $325 away in an account. Okay, so it just depends on your preference of what you want to do. Socking away $325 is going to take a while to accumulate a fair amount of money to take care of somebody after you die. So you just have to kind of take on that risk. Speaking of risk, here we go. All right. Your variable annuity. So a variable annuity. So this is number 17. I'm confused. This was 16. No? Are there two 16? Yeah, I guess I did it twice. Did I do it twice? I guess I did. Okay. All right. Well, better than not doing it at all. Now we're on 17. Okay. Variable annuity. An annuity is a payment each year. I hopefully learned that that varies. Some life insurances have what's called a variable annuity behind it. So if a person dies, the beneficiary receives the proceeds of that variable annuity. The expense risk charge at an annual rate of 3% of the account value. Your average account value during the year is 25,000. What is your mortality and expense risk charge for the year? So you take 3% of the value, right? 3% of the value, which is $750. There are fees involved with certain life insurance policies that you have to pay, or you don't even realize you're paying it. It's actually kind of coming out of the account that would pay somebody if you passed. Okay, so there are certain fees. That's how the life insurance companies make their money. How does a life insurance company make their money? How does any insurance company make their money? They take your premium, and there's so many people that don't file claims, right? That pretty soon it's like, you didn't file your claim, so we didn't pay you anything. So yeah, but you paid for that assurance or insurance of if something happened. So anyway, that's why some of the policies have cash value at the end, because you paid in quite a bit. So it's worked out that you get something for your money if you don't end up using it. Okay, this next one is another kind of fee. It's just an administrative fee. Now be careful. This is 0.215%. Okay, and I'm going to highlight this as yellow, because don't think that that's, you know, you have to be careful. Fees usually aren't real big. Okay, if you calculate something that's really big when it comes to a fee, and you're going to see fees in investments too. If you calculate a really big fee on an investment or on a life insurance policy, you better go back and look at your number, because you might have it off. So if you tried to put 21.5%, you'd get a pretty big fee here. Okay, so this is actually the number 0.215%, which actually converts to the decimal 0.00215. So this is a little number, right? So this is a $60,000 account policy that gets an administrative fee charged to it each year, so that $129 is paid. Okay, $129. So once again, if you calculate so just so you could see it, if you tried to stick in 21.5%, you would put 0.215, right? And I could put that in here. So they're saying 22%. If you tried to do 22%, oh my gosh, look at how much that fee would be, right? That's a lot of money compared to the account value. So whoa. So you don't quite have your decimal figured out, or the right percentage figured out. Okay, so now let me put it back. Yep, back to 129 bucks. Okay, that's it. I'm gonna let you go. You can have an early Halloween, or at least from me. Go eat lunch or whatever. I'm going over to the bookstore later, because I got a good discount on some Butler merch. You go in there with something unusual to wear, and they give you more of a percentage discount. So this is the time of the year I go buy something over there if there's something I'm wanting. So, okay, guys, I should have the 13 video up pretty soon too. So I'm going to stop so I can stop my recording. Okay.